And now another panel discussion is going to start. It will be about Investech. Investech, money, make money. And I'll invite here the moderator of this panel, Vladimir Vanyo, the digital economist, lecturer, keynote speaker, and journalist. And now the stage is yours. You invite your guests here. So I even pass you the microphone.
Thank you very much. I'd like to invite the panelists of this panel, Jonas Winbladh, Johan, sorry, Mussil Lyadvinsky, Robbie Schwertner, and Walter Mussil. If we have them, Walter, please take a seat. Robbie, yes. Welcome, and Maxim. Before we embark on the debate, I was asked to again thank the partners of this conference. The repeated exclusive partner of this conference is Tetra Banka. The main partners are DXC Technology and Ministry of Finance of Slovakia. And important partner is the Embassy of the United Kingdom of the Great Britain and Northern Ireland. Very briefly, a few words about our distinguished panelists, starting from the side. Mussil Lyadvinsky is a co-founder and CEO of Bloomio, which is redesigning the venture capital industry by a digital investment platform that connects startups and the SMEs. Robbie Schwertner is representing Crypto Robbie, and he's licensed counselor for business development with focus on blockchain and innovation strategies. Walter Mussil, is a partner of the Quantic Risk Solutions, which has recently become a member of the C Quadrat group. Quantic Risk Solution has developed a proprietary innovative forecasting prediction model and risk engine for corporate and fixed income data, based on which they provide services for dozens of major financial institutions and central banks. And last but not least, Johan. I apologize. I don't know why I thought I should read it, Jonah. Johan Winbladh is a university lecturer at the City University Vysoká škola managementu here in Bratislava, Slovakia, but before that he had an extensive career in the Big Four consulting companies as a leader or project manager for international institutions focused on projects focused on quality assurance, financial management, and financial consulting, and he is teaching finance, economics, operations management, and business strategy. So I apologize if I left out some of the important information, but for the sake of the brevity, let's move to the main topic of this this panel, and that is, if I could ask you in a kick-off statement, one of the challenges when we speak about financial fintech, financial technologies revamping the arena of finances, everybody can spot the differences, obviously. Could I, on contrary, ask you a provocative question, starting with Maxim? Where do you see the similarities between what you do and your technological innovations within the finance? Where do you see similarities between the new fintech world and the old world of the human advisor, if there are any, in your opinion?
Okay, thank you for good question. Actually, there is a lot of similarities because both fintech companies and financial institutions, they sell some financial products to retail investors or qualified investors. But the difference is that fintech is mostly trying to sell to retail investors, and they find ways how to do that the most efficient way, how to reduce transaction costs, etc. This is why a lot of fintech companies succeed, just because they sell good products and they sell cheap. And by the way, I liked the previous case when the guys sold hedge funds, as I understand, to retail investors as well. This is exactly about this kind of innovation when you use gamification, ease of use, low transaction cost, and offer products to some retail investors who might not even know without a good application how to buy these kind of products.
If I may, Robbie, one of the areas that you are focusing is societal impact of digitalization and smart villages. Will there be a human society in the future of digitalized, technologically driven financial world? In other words, is what your companies are doing driving jobs away from humans?
A very good question. The question is, when we see blockchain technology as a very young technology, as a very, to my opinion, and I fell in love with this technology, a very this blockchain technology will definitely revolutionize the fintech industry, the old economy and the new economy. The reason is that there is an underlying economic model which is called the shared prosperity model. What we have usually, we have the company model out there. So we have investors, we have people who create a service that are founders for young companies or the company itself, and then we have end consumers. They get a nice service, they buy a financial product, and so on. In this new blockchain-based world, which I see coming not so soon, but it will come, it's unavoidable, because the underlying economic theory is the so-called shared prosperity model, where you have investors still, they can also invest. We have people, blockchain consultants, blockchain companies, startups who implement products, but also you have end consumers. But the end consumers is also part of the whole venture because they also get a share of the profits. So your question whether they will disrupt jobs, yes, I think the banking industry is in its present dead. The conservative bank will be dead because we don't need somebody who holds a bank account for us, but we'll have the bank account on our mobile phones. It's called wallet, and we have it already. There is a wallet. The new Samsung has even a crypto wallet integrated, the Galaxy 10. We see this. I'm regular every 2 months, every second month, I'm in Korea. They have it already. So what we see is we will lose a lot of jobs. And as we know from internet, there will be a lot of new jobs. A fact is that people who are born today, we don't know in 10 years or in 18 years what jobs they will have. Because if you take the 10 years old now, 10 years, 12 years old, would we have predicted that they will be social media managers? That they will be on Instagram? There was no Instagram, there was no Facebook, so they will, you cannot predict that. But what I see will have new jobs, that's for sure, and maybe a lot of jobs will be done by machines, because when we talk about money makes money, we work on models where machines negotiate. I will later maybe explain that. Where machine negotiate, not only humans trade, but also machines. That was a long introduction. By the way, I'm Robbie Schwertner. I'm from Austria. I deal with blockchain. I consult very small companies or very large companies, so startups or huge multinationals. That's what I do.
Yeah, thank you very much for adding to my introduction. As a side note, one of the Austrian, just so that you know, political parties, Freie Partei of Österreich, pays 11,000 a month for its social media manager, maybe because it's a wife of a former chairman. Talking to how lucrative the new jobs are. Walter, what your company is doing is super impressive, and one of your areas is a quantitative artificial intelligence, which creates market investment strategies and decision processes automatically. And again, just a provocative question. President Donald Trump has or is going to be impeached. The Nancy Pelosi, the Speaker of the House of Representatives, announced shortly, which brings back the memories of the impeachment of Bill Clinton, which happened shortly after the collapse of the long-term capital management. You might remember 1997, which was one of those first algorithmic investment funds. How would you respond to somebody who's not an expert in your field, speaking about machines that make money? Are algo traders or artificial intelligence being brought into the world of analysis, quantitative analysis, a similar risk, or do they improve efficiency of the markets?
So thank you. That's also a very interesting question. Maybe a very brief words what we are doing and what our approach is. As you said, we are analyzing roughly 50 to 60 million corporates globally, automatically linking them with macroeconomic factors to forecast the fundamental financials. So that's basically what we are doing. Using those forecasts, those fundamental forecasts, both on a risk perspective and also from an investment perspective, linking this with capital markets, with equity prices and bond prices. So first of all, quite importantly, you pointed out, I think it needs to be differentiated between kind of those high-frequency trading algorithmical systems, which easily increase volatility and emphasis and kind of overpace certain market sentiments and market movements. I think that's something which very commonly is in mind with market panicking to some less fundamental events already. What we are analyzing with our systems is basically more the fundamental impact, what will happen with companies fundamentally if certain macroeconomic events are happening. Basically, unemployment rate is rising in a certain country. What is the impact on all the corporates there, not just the listed companies, but also all the non-listed companies, and then deriving based on this impact, an impact on capital markets, on the companies in capital markets, and basically see what the reactions might be on their fundamental valuation, on their stock prices, on their risk from a debt perspective, from a credit perspective. So I think that's quite a different, slower analysis to a certain extent, but avoiding this kind of overpaced reaction to events as you just mentioned. So, sorry again, a little longer answer maybe as expected, but
no. Thank you very much.
Okay.
In that, if I may, I would like to follow up with one, as an economist, quoting your compatriot, Mr. Hayek, who already in 1948 said that it's impossible for any central brain or central machine or central planning bureau to mimic the functioning of the markets. And just yesterday, I was in a TV debate where somebody challenged, like, oh no, with the big data and with exactly what your company is doing, maybe we could actually replace the market with some intricate machine. What would you say to that?
No. No, of course, there is always human behavior influencing the market in terms of investors' expectations, which reflect in the market. Of course, again, I would like to distill kind of fundamental perspective. If we go back into the financial crisis, we have seen that credit spreads from a pure fundamental perspective, the component was also increasing, but the large extent driving credit spreads there was more market expectations, driving the spreads really tremendously high, rather than the pure fundamental fluctuations, of course. And most of you know, in the credit markets, there hasn't been that many defaults as you would expect it by tremendously increased credit spreads. So this is something, again, this differentiation between this pure fundamental fluctuations rather than the more specific behavior of market expectations. Yeah.
Thank you very much. Following our very distinguished guests, Maxim from Geneva and Robert and Walter from Vienna, who do very impressive things. Johan, you have an experience teaching at the campuses in Beijing, in Lucerne,
yeah, I've been
worldwide.
teaching in China and in Switzerland.
So the question which I cannot resist asking, and you are based now in Bratislava. I think this is rather unique conference in it that it brings these topics into Slovakia. Would you say that Central Europe is behind when it comes to the pace of fintech revolution compared, for example, to China?
Yes, far behind. There's no doubt about that. China is very far ahead when it comes to all usage of technology, both for good purposes and bad purposes. I'm very happy we don't have a social ranking by social media in Europe, where depending who you're talking to, what you buy, you get a different ranking, and you may not be able to buy a high-speed train ticket because you bought too much alcohol last month. So it's used for all aspects in China. I don't really want us to see that here. However, what I see in Europe is a lot of development, and I see technology moving very fast. And I do believe that big data, algorithms, or deep learning algorithms is the future. And deep algorithms, learning algorithms and big data will be better at making decisions than humans. Just such a simple thing. Here I have an ordinary smartphone. It knows more about me than I do. That's a fact. It knows more about the world around me than I do. And this is just the very beginning, the cradle of the usage of all this data. In the future, I see my phone, or the data my phone it's collecting, communicating with other people's phone without me even knowing it, and telling me, do you want to do that? Do you want to do this? But why should I have to make the decision? Maybe the algorithm can make the decision for me. We'll probably make better decisions. And this is particularly true in investments and making money using technology. High-frequency trading used on historical data beats the market with 300+% per year. But now, luckily, there's not one person, one company running high-frequency trading. They're all competing. So it's a dog-eat-dog environment, so the returns are more normal.
One inevitable follow-up question that comes to my mind: efficiency versus freedom. I mean, an economist would argue that, for example, the system of the social credit minimizes or removes actually transaction barriers, because it's very transparent who you are dealing with or who you should not deal with. Technically, it's minimizing the risk in the system, making the system more efficient, though it strips the people of maybe some scope of the freedom. Aren't we, as you mentioned, the moment you turn on your cell phone, don't you give up your freedom of anonymity by default?
True. There is no privacy. There is no anonymity. Google collects everything.
Maybe, again, as an economist, wouldn't the way how to compensate for that? There is a school of thought claiming that in the future we will not use currency, but the data will be the currency of the future. For example, the personal data or data about our consumer behaviors.
Data is obviously very valuable, and we give up our freedom, but we get something in return. Just as an example, like 1 hour before I'm driving to Vienna, my phone tells me, don't take this motorway because it's going to take you 2.5 hours. And I'm not thinking, how could my phone know I'm going to drive to Vienna in 1 hour? Because we give up this freedom for other perks and benefits. So we're paying Google with our data, and they give us something in return. I don't pay Google with money. I pay them by giving up my data, giving up my privacy.
Would you argue against these free services? What Warren Buffett says, if you get something for free, it means that you are the product.
That is perfectly correct. There's no such thing as a free lunch.
So would you argue for paid services online?
Personally, I given up the idea of privacy a long time ago, so I don't really have a problem sharing my data with Google. But if somebody else wants more exclusive service where the data is kept and not shared, well, that service has to be paid. Maybe it's useful for someone, I don't know.
Back to the institutional perspective, Maxim. When I was speaking at a conference, innovation conference in Krynica in Poland, I heard a strange term, which was a startup lifestyle, referring to a lot of these brilliant entrepreneurship ideas flying around and being met with a lot of the money. Is the platform such as Bloomio helping to make this startup landscape where a lot of, let's say, unviable ideas are also competing for the cash? Is a platform like yours helping to eliminate what some economists could consider a wasteful use of social money?
Sure. Our platform, like many other crowdfunding platforms, they allow to fund easier different startups. And why it happens? Because we have risk sharing paradox. For example, putting $50 and putting $50,000 to different thinking processes. This is why it is easier to get a lot of people giving you $50 rather than to find one more serious qualified investor. So in this case, it is a bit easier to get money from the crowd for your startups on such platforms. And but at the same time, all the platforms, they have some barriers. They have due diligence process that will not allow if you are a scam startup, you will not be able to get money normally, because we have also a reputation of the platform itself.
What happens with the data about the failed projects on platforms like yours? If a person has previously launched and founded a project which didn't work well, does that prevent the person from using the platform again to raise for another project?
Normally, the platforms, they have KYC process on businesses and on the founders. So if the founder is not that good, or especially if he has criminal records, it means he will not be allowed to raise money.
What I mean is just entrepreneurial risk. Yeah, back to what Johan said. If you had a project in the past, I mean, there's this school of thought that one of the reasons why Europe is lagging behind the innovation and entrepreneurial drive of the US is that we are here in Europe. We are afraid to fail. Try the new things and fail. If somebody tries a project and it just doesn't go as expected, does it mean that he's done?
No. Actually, you are right. There are two mindsets. For example, in California, if you failed, you are good. You just do another project. In Europe, if you have failed, people start to look at you that you cannot start any new project. And but I think this mindset will change in Europe as well, because for consumers, and actually I'm coming to probably a different topic. Consumers, they do not expect only profit. By consumers, I mean retail investors. They do not expect only profit. What they expect some nice guys, nice teams that can change future. They can create some product that didn't exist before, and they do not think about profits. They just think about supporting this particular team because they like what they're doing. So profit is important, but not the most important part. And it was, by the way, justified by our research. We did a research together with IMD Business School in Switzerland of retail investor profile, and we have found that more than 50% of retail investors, they do not mark profit as their main driver when they put $50 or $100 into this kind of business. The main drivers are supporting something you believe in, etc. This is why I think if startup founder has failed and then he has a very bright idea, and wants to restart, I think the crowd will allow him to do that, because the crowd they look for something great, for some great ideas, not just for profits.
So ultimate democratization of finance, you say?
Kind of. This is why we talk about venture capital disruption. What we do, we want to disrupt this venture capital industry.
Very interesting. Robert, back to you. From a viewpoint of economist, correct me if I'm wrong, the biggest, the uniqueness of the blockchain technology is that we've had digital money even before. Most of our money has been, ever since Nixon in '71 cancelled convertibility of dollar into gold, most of our money has been zeros and ones, the digital money. What the blockchain brought in, the problem with the digital records up to now was that they were easy to replicate, easy to copy. You just plug in your CD, floppy disk, UBS, you name it, and you can duplicate your data. Blockchain brought in this factor of unmutable, unique data record, at which point we as an economists flocked in, because once you have a uniqueness, you have a scarcity, you can have the interplay of the supply and demand, and you can have a price. Maybe inflated price, somebody could argue about the Bitcoin.
Yes.
But my question is, there are first experiments to do alterable, mutable blockchains. Accenture, for example, or other consulting firms are looking into how to make a blockchain alterable in the past. What do you think about such experiments? And would theoretically it be possible to go back into a blockchain and alter the records? Wouldn't that kill the idea as such? It's a provocative question.
Yeah, it's actually not a very provocative, but it's a quite obvious question. Blockchain lives from the idea that you just always continue data sets. So you freeze data and continue with that. It's like the land registry. You continue writing and you don't erase the data, but you just correct and say, okay, that's the new owner. But you can see in the old records the old owners of a property, for instance. Blockchain works also like a ledger, or so to see the records of the finance. So the idea is to have a data set which can be followed up to the very root, genesis block, the first block of the blockchain. So that's the idea, and that makes it very safe. That is a property which could be changed. We see, for instance, if let's say Bitcoin is the very first blockchain which really proved to work in a way. It's very robust. It's not very elegant in its code, but it's very robust. Yeah, it's like you would say. I worked in Russia. It's like the Russian way of coding things. It's that when you have a Russian truck, it's a bit bigger. It's a bit more robust. One can question whether you need it, but it works kind of. Yeah. So the Russian. Then there is Ethereum, second largest blockchain, where you can build smart contracts. And smart contracts are little programs where you can execute. It's a very simple, not so difficult contract. It's if-then. If I get the car, I pay money. It's if-then function. If car, money goes there to the seller. So these smart contracts are so-called also immutable. They can run and not change. This in IT turns out to be a nightmare, because if you do, if you code it not properly, you cannot fix bugs. So that makes it weak. So when we say the altering of the data in a blockchain, I think this principle should stay. But when it comes to little programs run on the blockchain, these so-called smart contracts, very disruptive, by the way, to financial industry, insurance, and so on. With smart contracts being immutable, that is difficult. And we have projects, yeah, like EOS blockchain, where you have mutable or changeable contracts. You can change smart contracts during running, which is nice. It is nice to say to correct it, but not so nice from a financial perspective. If you agreed kind of, and a smart contract is like a code by law. It's self-executing contract. If you get the car and you confirm electronically in future, for instance, you receive the car, you pay the money automatically. If you change the contract, you pay half the price, someone will complain. And with blockchain is the problem, where do you call and to put your complaint? So you miss out, because blockchain is decentralized. You cannot call Bitcoin tomorrow and say, sorry, I didn't get my funds. There is no authority, no company behind Bitcoin. So the problem is that with this, it needs to build up a new authority. And for EOS, for instance, and I help to build up, there is a new jurisdiction arbitration platform which solves such disputes. So you need a specific legal forum, which we will see. We will not only see new money, we will also see new jurisdictions. That's what I predict. And we have that already in place.
Very good question. Frankly, I'm not really a strong proponent of blockchain money. What I like is what you have mentioned, application of blockchain outside of the finance. For example, what you mentioned,
yes,
the land registry. I mean, the theory of economic thought says that one of the biggest economic contribution of the Emperor Maria Theresia in Central Europe was establishing the land register, the
yes,
old written but still land register. There are still, unbelievably, when we look at the 7 billion people in the world, money making money that's concerning maybe the richest 1 billion, as in the Western world, so-called Western world. But still, for the remaining 6 billion, there are still places in the world where such a thing, such a medieval thing, such as land registry, is either not existent or is very inefficient. Could we call blockchain maybe a Maria Theresia in terms of the, if terms of enforceability of property laws, which are at the very heart of the market economy in developing world?
I mean, blockchain is not the medicine for everything. It's not the drug to make things better again, which are wrecked in the beginning. Blockchain is a database. So it's a database. So when you for instance, I was in the jury for blockchain real estate competition in Crypto Valley 2, Switzerland. Crypto Valley is the heart of European blockchain companies. They have it's a small city, 600 blockchain startups located there. So we saw the projects in land registry from Nigeria and Uganda, and the question, of course, of the jury members was, okay, it's a blockchain-based system and there is already a blockchain-based land registry in Dubai, Sweden and other countries. But how do you deal with the entry of data? If you put in the very first blockchain corrupted data that this doesn't belong to a certain person but to another person, if you put wrong data into the blockchain cannot be blamed for that. So the blockchain is not a solution. It's the so-called third-party problem. Okay, bless you. So it's called the third-party problem. When you enter shitty data into the blockchain, you will get shitty results. It doesn't heal. But the blockchain itself, it's for sure, it makes sure that it cannot be changed easily. That's nice, because these records, for instance, I also worked in Georgia, Caucasus, sometimes they had also difficulty with land registry. And the problem was that the paperwork sometimes, it got lost, it was changed secretly. Even in Austria we had cases where secretly they changed the land registry because of wrong address, and they put something in, and then you have a certain period you can object, but when you never got the letter because you failed to have the right address, you never objected, so people lost their lawsuits running like this. So it's not always the developing countries, it's also Austria. With blockchain this would not happen so easily, let's say. It could be better, but it's not the medicine for everything.
It's not a panacea. It's interesting what you mentioned, what in economic models is called trash in, trash out.
Yes.
Walter could tell us about economic models, but what your artificial intelligence enabled forecasting models are resembling. Speaking of money making money. How do you, maybe a bit theoretical question, but how do you respond to this, when we look into the future, to this objection that in the future, in terms of the social benefits of artificial intelligence, it will be the owners of the code, the owners of those machines, producing all those benefits that will be reaping most of the benefits. And then there is obvious question: should we allow, as a society, a private ownership of artificial intelligence machines or proprietary forecasting models? I understand. Would it be too exaggerated to call what your company is doing and your proprietary models a holy grail of the investment, like those machines that never make mistakes and only earn money?
It's again a tricky question. So let's try to answer it from different perspectives. First of all, I rather would basically slot what we are doing more into kind of a deep data analysis rather than with traditional statistics and traditional mathematics, rather than kind of a self-learning artificial intelligence systems as we might know from telecommunications and so on. So that's a little different. First of all, so that's one thing. I think the second thing, as said, we're running statistics on a large number of companies, large number of financial institutions. Statistics can help you with large numbers and with systematic analysis. What statistics and all those models hardly can tell you is like one example, Volkswagen has some creative programmers who do some funny coding and causing basically huge scandal, huge drop in value, huge lawsuits and so on. Such things, they are basically very hard to capture with such an approach as we are running. Yeah, this would require a different approach. So again, coming back to what you have said, is kind of a holy grail. Hardly, because still it lacks certain components which drive certain movements in the market, valuations of the company, and so on. So there are still a lot of idiosyncratic effects and events which might impact the value of the company and again also the value of your investments. Yeah.
If I may, having the knowledge of your, again, AI-based forecasting model, which is super impressive, and something that Robert mentioned before about the future jobs, which we don't even know what will they look like. Based on what you know about your model, would you then argue that it's not worth forcing our kids to teach programming, coding, and exact science because the machines will do that better? Or how would you answer this question about what skills will be valuable for the future generations in the world that technology is changing as your company does?
And again, I think this was also, you brought this comment before actually, coming back to my own person when I started mathematics in Vienna, and it's quite a while ago. I'm not commenting how long it's ago, but it's quite a while ago. I never imagined that I will basically do what I'm doing today. Yeah, so that's kind of a complete. The world has changed dramatically, and coming back to your question, having a kid myself, which is 10 years now, I think the most important thing is to teach creativity and open-mindedness, because actually what they will need to do and what might be kind of the areas where they can apply their competencies and they will make money with will change. Even in 10 years, it's very hard to say, okay, please learn this area, because then you will have kind of a safe job for the next 50 years. That's clearly not the case. And looking back, actually, my own father, now being 90 years old, he spent 45 years with the same company. So it completely has changed, and so it's extremely tricky to basically make any kind of outlook what might be the best profile. I think what's quite important is to keep creativity as high up as possible, to keep flexibility high up as possible, because things are changing dramatically fast.
Johan, as a professional educator, one of the things, I mean, Walter refuses to admit it, but what his company and its software solution is doing, it's actually gradually eliminating much of the, not all, but much of the work of the portfolio managers. Your software can do these predictions without a human interface. As an educator active in educating future finance managers, how do you respond to this change that the technology is bringing? And then the second sub question: how you as an academic respond to this answer? Should we allow private ownership of the AI, the artificial intelligence, which in the future will be not only able to make money, but it will be able to improve itself much faster than any human is able to improve itself?
Well, the technology is disruptive. Labor market's going to change immensely. Jobs will be lost. Lots of jobs will be lost. Everything that can be automated will be automated. For example, credit decisions are already automated in many banks. Portfolio managers are disappearing already today. They're replaced by algorithms, because algorithms can work 24 hours a day. So it's obviously disruptive technology. What would I recommend my students? 2 things: specialize and be a generalist at the same time.
How come?
Well, humans have to be generalists. Specialization is for insects and algorithms, okay? So we have to be generalists. Have to realize wherever we start our career, it will finish somewhere completely different. But study automation, study a bit of computer science, learn a little bit of programming at least, so you understand how the technology works. I would tell all my students, already tell all my students, study 2 things: languages and technology. It's not enough to study economics and finance. You need languages, you need technology. Because at least in the future, we'll communicate orally with each other without using any kind of technology. So knowing a few foreign languages is not a bad thing. That can help your career. But the technology will take over, there is no doubt about it, and it will disrupt the profit models and the business models of traditional industry, including the banks. The banks will have to change their business model with the technology if they want to be profitable. And also the technology is basically taking profitability away by lowering the costs and making it possible for everybody to replicate the technology. So having a competitive advantage in the future will be much, much more difficult. So we're coming to something that an economist will call a perfect competitive market. We're getting there. We're not there yet, but hopefully I'll live long enough to see it. Yeah, it probably comes much quicker than we think. The changes are just around the corner. And when it comes, it will not come slowly, it will come rapidly. It will be like a tsunami changing how these businesses are functioning. If you're supposed to be allowed to own an algorithm, was that the question?
No, the question is, AI in the future,
Yeah.
using, for example, the predictive models that Walter's company is developing, will not only be able to earn money themselves, but also improve themselves. And the argument is that whoever will own the best algorithm will ultimately, when we discuss now the high concentration of wealth,
Yes.
there is a school of thought which says that the AI will make, let's discuss whether it will democratize the finance or whether it will, on contrary, make the financial wealth even more concentrated. There's an argument, if you have a algorithm or superior algorithms like the ones that Walter's company is developing, you get richer faster than all other members or participants in the market.
Okay, well, we can draw that one step further. What if the algorithm functions as a juridical person? An algorithm can own the wealth itself. Maybe you don't need humans at all.
Matrix?
Sort of. That's the ultimate end of this with technology. I don't think we'll get there because I think humans will be able to control the algorithm. But I don't see any legal way to stop people from using artificial self-learning algorithms to improve their situation. And of course, this may lead to concentration of wealth, but that's not necessarily. Because again, an algorithm is easy to copy. So if he's got a great algorithm, well, there's probably some clever kid in Asia who got an even better algorithm right now.
If I may, Robert wanted to respond, but just a short response from Walter.
Yeah.
Is it that easy to copy, for example, your proprietary forecasting model?
I hardly doubt it. I think it's a mixture. So what does the system imply? The system incorporates basically the experience of all the people who developed it. Yeah, and I think that's quite, as I said, it's a fundamental system incorporating experience of fundamental markets, fundamental perspective, financial services industry of the last 25 years. So I think that's quite important. We actually had a Chinese PhD student who one of our clients asked, hey, please do something similar for us, and he completely failed due to a lack of experience. So it's always a combination. Of course, you get the statistical skills you learn at university to code some artificial intelligence or some smart statistic routines, but to apply them and get consistent models working consistently across the world, across basically a comprehensive system is very tricky. It's a mixture rather than pure self-learning. This is actually where the human experience drops in and steers the research and the coding into the correct direction. I think that's very important. Rather than just doing some mathematics, here is the data, go for it. This is not the way it works. You will get a lot of individual good models, but it never will produce a consistent outcome. Give a very simple example. Yeah, take a balance sheet of a company. You take like the total assets, liabilities. You take some macro factors. You run some regression analysis. You explain each individual factor perfectly fine, but it still will not add up to a consistent balance sheet because it's simply not working. Numbers will not add up anymore. So you need to guide the algorithms to get consistent results, both on a risk perspective, as said, but also from a valuation perspective.
Good news, there is place for humans in the future. Robert wanted to react before I ask Maxim.
The concentration of wealth. I looked at it, of course, this is an important question because the question is also, when I support blockchain projects, do we create another monster? That's a big question. Do we enable that we can have social credits very easily in the long run for governments to make use of that in a bad way? Also make redistribution of wealth not possible. What I think is we have always a powerful tool against concentration of wealth, and that's taxes. We have simply, when companies just come like a tsunami and grow very fast and gain so much wealth, we have to tax them. We have to make sure that they don't grow too big. We have competition law. We have anti-monopoly laws. We have all that. We don't have even to invent these things for new. So we have just to make use of them. What I think we made a lot of mistakes letting these platforms grow so fast. This we shouldn't allow because I'm working on a project, for instance, in the mobility sector. We have a look at autonomous driving. When you try, it's a model, but we have already proof of concept, it works. For autonomous driving, the question is you could, on a very a lane with lots of traffic, you could make a fast lane and a slow lane, and then you could make the cars negotiating with each other, as also you mentioned negotiating phones with each other. We could mention cars negotiating with each other, who goes right and who goes left and can go fast, who can go use the fast lane and left. And the one who can go fast pays to the other who goes slow some coins, money, whatever. So we have that works already because autonomous driving, you don't have a driver who owns the car. Ownership is sometimes separated from the car itself. And we have such kind of things which calls DAO, distributed autonomous organizations. That's on blockchain possible. You have kind of viruses, computer viruses, which are now nasty, but just let's assume we have companies on the running just on a code on a blockchain which do us good, do good things, like they do my accountancy. I would love to have such thing. My tax report, I would just copy all that. We will have DAOs, distributed organizations on the blockchain which don't belong to anybody. But what I think when it comes to AI, because we thought about this too, when they make profit, I think this should come to kind of United Nations tax organization, or United Nations, where this is a concept of Ethereum, the world computer of Vitalik Buterin, founder of the second largest blockchain. So we will have a distribution mechanism in place. We will need that, yes, and it will be maybe another UN organization where we have no name for at the moment.
Very good point, which brings us to the next question, which I would like to open in the next round, concerning the compliance questions, a whole new word. But before we got to that, Maxim, my friend Hadar once described to me venture capitalism or venture capitalists, which your technology, to Blumio is trying to disrupt, as a numbers game. He said, you take $100 million, bet it on 1 million on 100 projects, and 97 or 98 will fail, and 2 of them will earn you back the whole money and a very nice return. This looks like a statistics game. And now the question coming to machines making money or money making money, in your experience or in your opinion, would in the future the human venture capital managers be able to perform better than computers? Wouldn't computers in the future make better venture capitalists than humans?
Actually, just commenting on failure rate. When we talk about the failure rate of startups overall in the world, it is true. But when you take a look at a particular venture fund, depending on their due diligence process, they have different numbers. So if you have good analysts, you can get better results. And here we are coming to artificial intelligence. If you have good algorithms to analyze all the background of founders, their story, analyze the market, and if the startup is a good fit for this particular market, probably you could have even better results with artificial intelligence. Just one drawback for that, and I have some fresh example from my relationship with one bank. I will not call it. A while ago, I wanted to buy some paper, and I could not. And then I asked my manager of the bank why I cannot buy this particular paper. And his reply was, according to your automatically generated risk profile, this paper is not a good match for you. This is why you cannot buy it. But if you still want to buy it, you need to sign a lot of papers so that we could allow you to do that. It means that artificial intelligence already frame my decisions. And again, if you talk about this automated driving, this artificial intelligence also frame my decisions. For example, if I want to drop myself at this particular point, taxi driver can do, but artificial intelligence might not do, because stop is forbidden in this particular point. And but taxi drivers usually they still can drop you out, but not with artificial intelligence. They will just prevent you.
You give the AI a bit more tip.
I mean, artificial intelligence is good, but when it will start frame your decision, prevent your decisions, at some point you might start feeling uncomfortable.
Thank you very much. Thank you also for the questions that you posted on the Slido under the hashtag FinTech19. I'll revert to these questions, Johan. One of the questions from the audience is, how will the university of digital age look like? Maybe I add to that, would there be university instructors in the digital universities of the future?
I hope so, certainly, but I'm not so sure. Lots of things can be done differently. We already tried pilot projects, setting up virtual classrooms where you can have one professor teaching students all around the world interactively in real time. It's already here. So maybe we need instructors, but maybe we need much fewer of them. So maybe that's the future. I don't think we're here yet, because in education I do believe in the human touch still. The key word is still. But when technology gets better, maybe that will be less relevant. Imagine a self-learning system creating online courses that is really monitoring what the student needs and what the student learned and what the student and monitoring their progress. It might be more efficient than traditional university studies. But we're not there yet, and well, we won't be there until I retire. That's the thing, and lots of jobs are going to get lost. There's no doubt about it. New jobs will be created, as you said, yeah, and I believe in that. That is because humans are generalists. We are not specialists. We are generalists. There will be new things for us. I mean, just take something from history. Horses are not involved in personal transport anymore, to any extent. They're used for hobbies, racing, whatever, but not used for personal transport anymore. So the horses are unemployed, right? There are fewer horses in Europe today than 1902. You can agree on that too. But we are not horses. Horses are specialized. We're humans. We're generalists. So therefore, I do believe there's a future for us.
I have an interesting question for Robert, but because you mentioned it, Johan, let's continue with you, Johan. Another question from the audience is, there is a theory. What if the newly created jobs will not be in sufficient quantity to substitute the lost jobs?
Well,
how do you think this balance will work? Newly created versus lost jobs?
Then we come into this with taxation again. We have to tax where the money is, and maybe we will have some sort of minimum subsistence or something like that, like the socialist ones. I'm sort of against that because I think it would lead to low productivity. Maybe we should give people a job guarantee in the future. You get some money from the government, but the government also guarantee you a job.
Basic, universal basic income.
But only against a job guarantee. Because there are lots of, I mean, just look around in Bratislava, you can find hundreds or even thousands of jobs that are not done. If you just look at the general environment around you. So it's not that there's not jobs that can be done. They're not done because it costs too much money. But in the future, if employment rate goes down due to automation, we better find those jobs. So universal income against a job guarantee, that's what I would say from my perspective.
Thank you very much, Johan. Back to the earth, Robert, a very practical question.
Yeah.
As I mentioned, Ministry of Finance is partner of this conference. I believe this question came from them. How does regulators in Austria, do regulators in Austria perceive blockchain?
Yeah, I deal a lot with them. With the Austrian FMA, is the Austrian Security and Exchange Commission. We negotiated with them, for instance, for a blockchain called Zero BS blockchain on an approach which is called compliance by design, where you have a blockchain, a technology, and when you issue, for instance, tokens, so-called security regulated tokens, that they automatically comply with the Austrian law. This is an approach. It's in the process of being done. What we don't have a blockchain law in Austria. Liechtenstein has that since a few weeks. Introduced is a 150 pages law on what blockchain should be. Germany published a strategy on blockchain this Sunday, 22nd of September, so it's really fresh from press. In Austria, we have ideas, we have an interim government, and we have visions, dreams, but not a legal, clear vision on how it's done. But what I can say is, when we look at the globe, US is very strict with cryptocurrencies. Every cryptocurrency is a security, so you have to notify. In Germany, the same. Even miles and more, flight miles. If you put that on blockchain in Germany, you would need a license and you must register with the German SEC, with the German financial authorities. In Austria, it's a bit more like, like Austria, we more soft. You can still have so-called utility token done without any regulation. Utility token is more a service token. You get a certain service, but it's not money-like. But when it comes to securities, of course, it's regulated. And blockchain technology itself, of course, they're open. The research fund supports blockchain research projects as a technology. But with cryptos, we are and Liechtenstein is very open. Switzerland is very open. That's why many companies go there. That's the other end of this scale.
Mm-hmm. Thank you very much, Robert. A question, I guess, for Maxim and or Walter. What are the major 3 new trends in this money make money or machines make money, in your opinion?
I rather would like point out trends are missing. And maybe I hand over then the trends to you. Maybe the trend I'm missing, money make money. What I'm seeing, and I think we also discussed it earlier, is there's a lot of yield seeking in investments currently, and I think that's quite important. High yield means higher risk, and in parallel, I miss the trend of learning from what has happened in the market in terms of risk awareness, because markets have been moving up. There's a lot of optimism in the market, and so people are getting kind of bullish in terms of risk taking, but without the infrastructure, or insights in there. And what I would like push, or basically can put back, try to put back into the brains and in the awareness, is basically to get the full transparency on the risks which are behind the yield you are taking. And this is something I've seen a lot in this industry, since we cooperate together with our co-owner T Quadrat in the asset management area. There are a lot of asset managers who push yield, return. And so I think that's quite important to get this transparency and leverage on the information which is available, rather than closing the eyes and go for it. I think that's one thing. The second thing, this is more like into the trend area, what we have seen from an investment perspective, is the ESG green driven investments. They are quite important and highly valued, and put very high on the agenda from an investor's perspective, both from an institution as well as from private investors. Still, being good on the green side doesn't not necessarily mean that you're good on a financial side. So a good green assessment not necessarily reflects on a healthy financial fundamental situation. So again, that's one example. One example where you also would move exactly in the same direction. So those 2 trends or lack of trends, and maybe I hand over to you.
Yeah, major trends in money make money.
From technology perspective, what we see a trend when more and more products are available for small tickets. For example, portfolio management with artificial intelligence becomes available for small tickets, and you can have your own portfolio manager. The venture capital is coming to retail investors, etc. So this is a clear trend of democratization for financial products.
Mm-hmm. Thank you very much. I think this was maybe just a very brief last round of very brief answers. If you had the miraculous, if you would catch miraculous fish which could fulfill you only one wish with regards to this to your professional area, what would be the wish that you would ask from this miraculous fish? Something that you think is missing and would propel the industry, your area further. Maxim.
Easier regulatory rules for fintech startups, because right now a lot of a lot of limitations are from regulators. And if it is easy, it would be much better and faster.
Thank you. Robert?
I would ask the fish how to eradicate poverty. Very simple, not more, not less.
Raising risk awareness also for an investment perspective, rather than, of course, the very fundamental questions, as you said, going back to money make money. Keeping this up and reminding people to keep memories longer than like 1 year or 2 years, but rather keep memories like maybe what has happened 10 years or 15 years before.
That goes back to 1997 long-term capital management. Johan?
Remove. Yeah, my fish will tell me to remove borders, make a true common capital market union in Europe, so we can make glitch-free investment independent if you're in Hungary or in France. We don't need different regulations. We don't need these borders. We should have one capital market in Europe, and that would be beneficial for all Europeans as well as for European institutions. Of course, some institutions are guarding their private turf and don't want this because they're afraid of competition. But that is what my fish would tell me to implement.
Thank you, Johan. So you are not a friend of the wall of American President Donald Trump, I take it.
Well, Donald Trump said yesterday that nationalism is the new black. Well, I disagree.
I think that's
I'm a little bit more of a globalist. But first, European integration, then Europe can integrate with the rest of the world.
I think that's a great idea to wrap up our session, because we stand in between the coffee break. So I would like to kindly ask our audience for a round of applause for our distinguished and very insightful panelists. Max Lyadvinsky from Blumio, Robert Schwertner from CryptoRobi, Walter Mussil from Quantic Financial Solutions, and Johan Winbladh from the City University Vysoká škola managementu in Bratislava. Gentlemen, thank you very much for very inspiring discussion. Thank you.